Let's get back to the broader markets. Bring in Katie Stockton, Fairlead Strategies founder and managing partner and a CNBC contributor. Tom Lee was just on. He's a fundamental guy, Katie. He was able, though, to actually call the trend before it happened, and he was bullish right at the beginning of the year. But he now says that 45.05 is the new support level for the S&P, and that this year will go to new highs above 48.19 or whatever it was. I forget exactly what he said. Does anything you're looking at technically lend credence to that notion that 45.05 is the new low end of the range and will go to new highs?
That's not my support level, but what I would say that's positive about the market right now is that it does still have momentum, and it also still has market breadth. Last week, if you recall, the targeted level for the breakout that we highlighted in May was about 45.10, and that was reached last week. So to us, it's actually more of a resistance area potentially than it is a support level at this time. The 50-day moving average is rising close to about, I think, 42.85 or so. So that to us is sort of the initial gauge on the downside. And the hard part about that is your risk reward has gotten a lot less favorable now, with the targeted objective having been met, and then with that distance to initial support. We're staying with the market. We believe the uptrend has potential to forge higher through earnings season, and yet we're very non-committal at this time. We want to, be respectful of any downturns that we do see, because that would be indicative of, potentially a pretty significant retracement.
It's pretty amazing, though, that two smart people, one with fundamentals, one with technicals. One sees a support level at 45.05. The other sees a resistance level at 45.05. You both can't be right. I guess over time you both could be right.
45.05 could become support going forward, but we would need to see pretty significant upside follow through to suggest that that's the case in our work, at least, because right now it's still intact as a potential resistance zone. So I love Tom. Tom's great. But yeah, we disagree on this point. Yep. The long-term gauges that we track, long-term overbought conditions are in place. So that to me makes it more challenging for the S&P 500 to forge to new highs. We do have a pending breakout this week in the Russell 2000 index. So that's a testament to the breadth behind the move. And it's something that could add a little bit more sustainability to it. So if the Russell 2000 closes above 1890 this Friday, it confirms that breakout. And the next objective there would be about 4 or 5% higher. So still potential upside. We're still seeing positive catalysts. And yet any loss of momentum would be pretty serious in our opinion.
So the Russell moving higher, the soldiers catching up with the Magnificent Seven. Does that mean the Magnificent Seven continue to go higher, or does it just mean that the soldiers catch up with those leaders?
The rally in those Magnificent Seven has really been unrelenting. I mean, we don't want to fight against that momentum. It still is largely positive, and even, Alphabet, for one, had already seen some consolidation and then advanced from it. So I think they've proven to still have a good bid to them. Maybe earnings will generate some more volatility. But for now, we want to stay the course long those names as well. So even if they lose their leadership stronghold and aren't outperforming in the way that they had done, we do expect them to at least participate while the market's trending higher.
Hey, Katie, when we had that ADP report that was almost 500,000, and the 10-year went above 4, just went right through at 4% yield, and the 2-year went well above 5, and then it all broke down. What's technically, what does that say about what we're going to see in either the 10-year or the 2-year? Are they in a downtrend now in yields?
Well, we believe that the corrective phase still does have a hold. I know that's hard to believe after the up move that we just saw, but the very quick retracement that you're highlighting left the breakout in the 10-year yield unconfirmed. So we have this retracement that we expect to continue. So we're looking for a deeper pullback in yields. Oh. The DeMark indicators that we track support that certainly. And obviously that the 2-year yields have very good resistance with very psychological significance right around that 5% level. So we're looking for momentum to remain to the downside there near term. As you know, we have seen a secular shift in yields. So we do ultimately expect a higher low, but that doesn't seem to be the case as it stands.
Commodities. We talked about wheat right at the top of the show. Wheat, price per bushel. I got it right. It was like $7 a bushel or something. Well, what about oil in the commodities complex? We've heard of a super bull market from Jeff Curry at Goldman Sachs, and oil's looked a little bit better in terms of for the longs, I think.
Well, it finally got back above its 200-day moving average, and it actually did confirm a minor breakout above that threshold. So that test tells us that crude oil does have the potential for upside follow through, perhaps into the next resistance, which is sort of like $81 to $82 per barrel. So we're looking for a greater relief rally, but we want to use that to reduce energy exposure. The energy names, a lot of them had short-term breakouts that have already seen good upside follow through, and that's within the context of weakened long-term momentum. So we want to use that strength to reduce. The metals complex has gotten very, very interesting. Copper, of course, is under pressure this morning with the China GDP data. But we think that the improved intermediate-term momentum behind the metals, both industrial and precious metals, is significant, and that we'll see greater upside there as well.
Okay. Metals. But you're talking about metals, not gold.
Including gold.
Including gold.
Gold, silver, copper, right.
Yeah, totally different dynamics, I would think.